Okay, we are 1 week in from the rate rises. Nothing fitting more than to bring in a awesome mortgage broker, Mr. Zach Constantinio, to talk about what's happening with interest rates and the market.
Wow. Good morning, everyone. Zach, thanks
Good
for joining
morning,
us. Special
everyone.
guest from Shore Financial,
Thanks, Billy.
here to give us the gossip. What's happening?
Well, mate, I think there's a bit of heat in this room. I can't imagine what everyone else is feeling out there in the mortgage market, but I need to turn up the ventilation in here. Hey?
It's as hot as the property market in our little studio this morning after 13 rate rises.
It
That's
is. Zach, are you worried?
Am I worried?
Mm.
I mean, things are always going to be all right, but there's there's reason to be thinking that things might be getting a little bit heavier than what we have at the moment. But we are out of step with a lot of other countries in the world. But 13 rate rises is a lot more than we wanted, a lot sooner than we wanted. But the reality is that there may be more. How about you, Mark? Are you worried? I know you're regulating the temperature this morning.
Yeah, definitely. Look, I think it's we're seeing more clients that are directly telling us that they are selling due to the rate rises, which we've never seen before. So we're 13 rises in. The shock and awe of the first couple of rate rises we found, had direct impact. When people got accustomed that they just knew rates were going to go up, they were sort of okay. But this last rate rise, and even just a touch before that, we started getting people actually telling us they're selling due to directly. They're selling due to the rate rises. We had people telling us, they can't afford, to the repayments, and that's why they're selling. So I think it's at a stage now where people have depleted their savings, or they're starting to seriously erode into their offset accounts, and then they're saying, "Look, we're going to make moves." The nice thing is that there's fat there for people. There's equity there. So once they're sold, they're not stuffed. They're just making arrangements to be in a better position. So it's not like they're stuffed forever. And it's just like it's like changing clothes. They're just getting into something more fitting with property.
Yeah, and I guess that's why we're still seeing numbers around opens and auction clearance rates, and because people are moving. There are other people that are, I guess, that unreported demographic of people that aren't technically stressed but are due to their own budgetary guidelines, and therefore don't want to put themselves in that position, so they will sell before they're in the category of technical stress. And that might be, mums and dads selling their investment property, or they're, refining their position. They're selling a house and moving into a unit, stuff like that. Like, are you guys seeing a lot more of one type of property transact at the moment than another, or pretty spread across the board?
What do you think, Billy?
Maybe Billy's got the insight for the apartment market here.
I think the transactions, the purchases, it's still pretty widespread. Certainly on the entry level stuff, there's still an appetite to buy. The first home buyers that I think are stronger than ever at the moment, with some recent stamp duty changes. So that's that's not holding them back. People that have been waiting to buy have probably been allocated that budget, factoring in all of those rate changes. So on the buying side, it's steady as she goes. But on the selling side, I think there's certainly a little bit more entry level home stock coming on than there was before. Overall on the beaches, we've seen about a 30-40% change in stock levels. So it's made things easy. It sounds like a lot, but we were operating in an environment where there were sub 500 properties on the market.
Well said.
And now we're getting into a more balanced market where it's just making it easier to transact buying and selling.
I think
Zach,
the impact's been massive on mortgage holders as well, right? So I think with the 13th rate rise, there's roughly $1,300 per month on average, an increase to a $500,000 mortgage, and around $2,500 per month on $1 million mortgage, which is huge, especially for people that have leveraged to their maximum at historically low interest rates 2-3 years ago, and have come off. That's where the shock factor is, I guess, hitting hard a lot. And I mean, even the first home buyers from between 5 and 10 years ago who might have been ready to go again and bought their first investment property, they're also in that category where, you know, there is a bit of that shock factor, and then maybe that's passed on to renters, and, you know, we're not seeing the rental price side of things slow down or retract. So there's a lot of there's a few moving parts and a wide variety of people that are feeling it, but there are things that are on offer through the banks. That's, you know, if you're thinking of selling and you haven't looked at negotiating with your existing lender, then there's definitely opportunities to do so to reduce the stress and potentially hold on to an asset.
I think that's big.
So Zach, tell me about a typical week over the last month that you're having with people that inquire. So who are the people that are inquiring to do deals with you? Are they refinancing? Are they buying? Who are the people that are talking to you at the moment? What are their sort of concerns, aspirations, or just what are the conversations? What's happening behind the scenes?
Behind the curtain. Yeah, look, it is a real mix. First home buyers, obviously, you know, they are, if you're born, you're likely to be buying a property at some point in your life. So they'll never die, that demographic. So there are a lot of first home buyers out there. So there's a lot of first home buyer inquiry. A lot of people are taking the position that, well, the market seems to have corrected. So, you know, if I can afford it now, if it works, if I can find the property, let's get in. They're forecasting growth, as a lot of people are. And then refinances. I've actually had quite a few clients recently that, you know, we've realised some equity in their property because the market has come back, and when presented that equity position and with the potential rate saving when they've come to refinance, we've found them in a position where they've been able to purchase an additional property. So there's a bit of a shift in, as I was saying, the people that have, you know, potentially bought their first home in the last 5, 7, maybe 10 years and haven't gone again, are ready to now because they've paid down their mortgage, they've been able to keep up with repayments, they've built that equity, and they've improved their income. They're in that accumulation stage. So, you know, they've come out of their 20s into their 30s, they might be approaching 40, and they're looking at, okay, what can I do to build my wealth? And then they speak to someone like me. We get a valuation done at no cost. We see that their property value has actually grown, their LVR is reduced, so we can then go and negotiate a better rate with the bank because the LVR is reduced. And then there's a bit of a repayment saving there if they just wanted to refinance. But then there's, you know, quite a few people in the last month that have asked to release equity on their existing property and then upgrade. So either buying a new place to live in, and keeping that as an investment, or buying a secondary property to throw into the rental market.
That's good.
That's a typical. That's what it's been typically for me over the last few weeks, which has been good to see. And we've obviously helped a lot of people with telling them what the most competitive rates are in the market for their scenario and being able to make savings. So, you know, if they're just sitting there rolling off fixed, or their bank hasn't been loyal to them in, you know, keeping them on the most competitive offer. That's why I'm here. That's why we do what we do, to make sure people are on the best deal.
That's where I'm interested. How many people are not being given the sharpest rate? What percentage? Could you make a general statement?
Oh, I'd say 100% if you've been at the bank longer than, you know, a year or two, because the best you get is a new to bank customer. As a new to bank client, you've got, you know, the best opportunity to get the best rate. because from there on, it's going to be tightened up over time. That's why people move every 2 to 3 years.
There you go. Okay, so now's a good time to make a call.
Zach, is it the case? And this is a harsh reality. I've been seeing it reported out lately. Is it the case where the rich are becoming richer and the poor are becoming poorer because of the way these interest rates are the level these interest rates are sitting at, that only really the fortunate few on huge incomes can afford to do refinancing? Or are you finding that if someone's got that appetite in any demographic, they can still do what they need to do?
I think you could probably say yes to both of those, because the clients I alluded to that have purchased their first time and are going again, they're by no means sitting back, putting their feet up and watching their money work for them for the totality of their lifestyle. It's not the case. They're in that accumulation phase. They're savvy. They know that there's people that they can turn to for advice. So property professionals and finance professionals, to actually look at their scenario before they make any decisions. They go about their daily life, and in this case, they were two young accountants, and they wanted to see what their position, how they could refine their position. So their first objective was to get a reduction on their repayment, and then they wanted to know what their next move might be. And I mean, unless you've got all the pieces of the puzzle, all the advice from, I guess, your team of people around you, I guess it's hard to make the right decision. And you may not make the right decision. If it's just selling out of an asset, then you don't have the holding, or if it's upgrading, you can get all the answers from all the people around you, myself included. So I know that there's a traditional shift of growth in wealth amongst the wealthy in inflationary times. That's, I think, common knowledge. But there's definitely opportunity out there for people that are, grinding it out, that are in the prime of their career, in their working life, and want to shore up their future.
It seems like the hustlers just keep hustling, irrelevant to their income, medium, low, or high. If you are a hustler, you are doing stuff with property. You're getting in there. You're making it work. You're saving money. You're just getting an extra job or two. This is the time to hustle. This is the time to hustle, and it's the whinging's not going to help. It's a matter of fact of, like our parents getting a second, getting a third job, just making sure that the income's going to support the and hustling to get out there to get a property.
Well, if you can make good in the bad times, imagine how good the good times are going to be.
I think you just nailed it. Nailed it. Yeah.
Finish on a high.
Yeah. Anything else to report?
I think Billy's gotten taller.
Oh, don't know about that. Don't know. I think
He's got heels on.
My back straightens out every time there's a rate rise. Actually, it makes me stand taller. What do you reckon next month forecast is? Another rise before Christmas, before New Year?
That would be very rude from the RBA. That would be very, very rude. I mean, there is that they've got to be careful in their data assessment. Obviously, they lifted them because they saw a creep in inflation that was largely due to fuel prices, and they actually reported that the retail spend was on the way down. So the local side of things affecting inflation, rather than the macro factors outside of this country, were coming more in line, and now we're sort of out of step with the other countries in that New Zealand, England, the US have all held, although we're still under their cash rates. We were, one to go last month. So it'll be interesting to see with what's happening around the world, both wars that are seemingly happening, and you've got the driving fuel prices, see what happens there. And then locally, we've got things like Black Friday and the run up to Christmas, which, they usually stimulate the spend and people get out there. And it's a time of year where, people want to get a little bit carefree. So hopefully they don't deliver another blow, but it's sort of likely that there may be another one, just because things aren't coming down as quickly as possible.
Triple Black Friday, it may be.
That would be a Black Friday.
It'd be a triple black. So they are meeting one more time before the end of the year?
In December, and then they meet in February next year.
Okay.
So January.
And it seems like everyone's very comfortable that rates are going to ease up next year sometime.
Yeah, that's sort of pushed out that same question 3 months ago. A lot of people were forecasting rates to come down as early as May, and I think the earliest expectation now is around August. More likely in Q4 next year. That whether that means in the interim there's one more rate rise or that's a hold from now until then, I guess we'll find out. But we'll be sure to keep you updated with the daily change on the expectation.
Yeah,
Billy,
I'd just love a bit of certainty. I just love a bit of certainty.
Nothing is certain, mate. Everything's possible.
Well, I'd like it possible that it might come back down, but no more going up. That's what I'd like to see.
So in summary, the takeaways from today, thank you so much for coming on, Zach. Billy, what are the takeaways for you from today?
I think if you can buy and you've budgeted to buy a place, don't let anything stop you back now. You're in the best time to do so. And there is light at the end of the tunnel. It's just a matter of time. We're probably at the hardest point now.
Yeah, look, I think if you are in stress and you want to review your scenario, reach out. Happy to help. My services are no cost to anyone here, so happy to review and give you insight on what's best in the market for your scenario. And at least you can go and negotiate with your existing bank and say, hey, I'm looking around. I've been quoted this. I'm going to leave. What can you do to retain me? Then at least you've made that phone call that can potentially save you thousands. Otherwise, we can refinance and find you exactly what's going to suit you best to keep your position consistent.
And you or someone's broker can coach them through how to talk to their bank.
Absolutely.
There you go. Have a great day. Thank you so much for coming in, Zach. You're an absolute legend. We had to get you up and out of bed at 5 o'clock this morning, 6 o'clock.
That's all right. I'll do anything for you guys. All good.
You're the best.
Mark.
Thanks, man. Guys, I hope this helped you today. And if you've got any questions, Zach from Shore Financial, look him up. He's a local Northern Beaches guy, but you can work all over Sydney. As long as the people got money, you can help them.
I can be anywhere, and I don't need your money. I just need to see where your money's at.
That's it. All right. Mate, thank you so much. Thanks,
All right,
Billy.
See ya.